Stop scrolling for a second. Seriously, if you hold any legacy financial stocks in your portfolio, you need to hear this. Because we all dread it, right? That sudden, unpredictable black swan event that just evaporates your dividends overnight. Well, today we're tearing down a company that took a completely devastating $2.2 billion blow. I mean, an absolute worst case scenario that would literally bankrupt 99% of businesses out there, yet somehow, just 12 months later, they didn't just survive, they posted a massive nine-figure profit. How on earth is that mathematically possible? Well, by the end of this explainer, you're going to know exactly how they engineered one of the most incredible financial resilience stories of the year and how you can spot this kind of hidden strength in your own investments. Let's bypass the fluff and dive straight into the numbers on Mercury General's ultimate 2026 resurgence. Okay, just take a look at this. Over $190 million in net income for Q1 2026. It's a jaw-dropping number, all on its own, for sure, but what really makes this fascinating is the context. This figure sets up a dramatic, night-and-day contrast with the company's very recent, incredibly chaotic past. We're talking about a company that, just a year prior, was bleeding cash and fighting for its actual corporate life against an unprecedented natural disaster. So you've got to ask yourself, how did an insurance company bounce back from its costliest disaster ever to pull this off in just one single year? It's kind of like watching a heavyweight fighter get knocked out cold on the mat, only to pop right back up 10 seconds later and win the whole championship. We're going to unpack exactly how a legacy company survived an existential threat to post these huge, immediate gains. It's essentially a masterclass in risk management. All right, Section 1. Let's look at the Mercury General story. This wasn't some flash-in-the-pan tech startup built on venture capital. Mercury was actually founded way back in 1961 by George Joseph. And get this, he was a World War II navigator who flew 50 missions before heading to Harvard. Talk about a solid foundation, right? He started Mercury as a low-cost insurance alternative. By 64, they opened their first Orange County office, eventually write their first auto policy in 77, and then they start expanding outside California into places like Georgia and Illinois by 1989. So they spent decades building this massive, sturdy national footprint. But as we'll see, all of that history was about to be put to the ultimate test. Moving right along to Section 2, the 2025 wildfire crisis. Right at the start of the year, January 2025, the Palisades and Eaton wildfires just violently hammered the company's balance sheet. Now, let's be clear. This wasn't just your standard bad quarter. These fires were officially the costliest catastrophic events Mercury had ever experienced in its entire history. Just look at this number, $2.2 billion. Let that sink in for a second. This was their gross catastrophe loss before taxes, an absolute worst-case scenario. To put that into perspective, for a company with a market cap of around $5.4 billion today, a sudden $2.2 billion hit is a structural earthquake. It's the kind of staggering figure that creates sheer market panic and ruins businesses for good. So how exactly did they avoid collapsing? Let's dive into Section 3, Reinsurance and Subrogation, to find out. This is where the magic happens. Notice the sheer scale of the disaster on the left. That terrifying $2.2 billion gross loss. But then, look on the right. The net loss, after reinsurance, was brought all the way down to a highly manageable $380 million. They essentially bought insurance for their own insurance company, right? And that massive financial safety net completely absorbed the catastrophic shock. Now, to be fair, survival wasn't completely free. Mercury had to cough up a $100.6 million reinstatement premium. Because those wildfires were just so extraordinarily severe, they completely blew through their catastrophe limits for the 2025 treaty year. So they had to pay over $100 million just to essentially refill the bucket and reinstate their coverage. But hey, a $100 million fee to avoid a $2.2 billion wipeout, that is a trade you make every single time. So they contained the immediate damage, but then things get really interesting. Because they went on the offensive, and they did this through a process called subrogation. Basically, this is the legal right of an insurer to pursue a third party that actually caused an insurance loss. We're highlighting this because this specific legal mechanism became Mercury's primary offensive weapon to recover massive amounts of lost funds. Mercury didn't just quietly take the hit and move on. No, they actively fought back. For the Eaton fire, they are aggressively pursuing Southern California Edison, and they've actually recorded an estimated $538 million in subrogation recoveries. And for the Palisades fire, They just went ahead and sold their subrogation rights for an immediate $40 million in cold, hard cash. I mean, they're actively clawing back over $500 million here. It's incredible. All right, Section 4. Let's fast forward to the Q1 2026 turnaround. The dramatic swing here is just undeniable. If you look at Q1 2025 versus Q1 2026, net income reversed from a very painful $108.3 million loss to a massive $190.4 million gain. And check out their combined ratio, which measures underwriting profitability, where anything over 100% means you're losing money on policies. Well, that ratio dropped from a bleeding 119.2% down to a beautifully profitable 89.3%. Meanwhile, those net catastrophe losses shrank from $447 million down to just $93 million. Guys, this is exactly what a V-shaped fundamental recovery looks like. And it wasn't just the main business doing the heavy lifting. Their investment arm absolutely stepped up to the plate. While the underwriters were busy fixing the core business, net investment income actually grew, climbing from $81.4 million up to $85.6 million. This was driven by higher average invested assets, so they were literally compounding cash even while navigating a historical crisis. Let's bring it home with Section 5, dividends and stability. Unsurprisingly, the major rating agencies reacted immediately to all of this. AM Best officially revised Mercury's outlook from negative all the way back up to stable, while also affirming their excellent financial strength and credit ratings. The really crucial point here is that AM Best stabilized their outlook specifically because the massive uncertainty surrounding those 2025 wildfire losses was handled so flawlessly. The broader market completely recognized the strength of that financial firewall. And look at these underlying signs of resilience. By the end of 2025, they didn't just survive. Their policyholders' surplus actually increased by $362 million to reach a whopping $2.4 billion. They kept their financial leverage super healthy at just 19.2%. And perhaps most importantly, they didn't just renew their reinsurance, they upgraded it. They built a massive $2.14 billion reinsurance tower to protect their future. So they came out of the fire, quite literally, stronger than they went in. And here is the ultimate proof of confidence. Despite the absolute utter chaos of the previous year, they continued to deliver shareholder value without missing a beat. The board declared a quarterly dividend of roughly 32 cents per share, maintaining a steady 1.3% dividend yield. They kept the cash flowing to the investors who didn't panic and sell at the bottom. So I want to leave you with this provocative thought to wrap up our explainer today. If Mercury General can turn a $2.2 billion disaster into a $190 million quarterly profit in just one single year, what other legacy companies are hiding massive, untapped resilience behind their balance sheets? Next time a macro crisis hits, maybe we shouldn't just be asking if a company will survive. Maybe we should be asking exactly how strong is their financial firewall. Thanks for hanging out with me for this explainer. Keep digging into those fundamentals, and I'll catch you in the next one.